The Fed will raise rates even in a recession. The bond market will face an illiquidity spiraling down. The jobs report on Friday showing in October, hiring is quite healthy despite some sign of slowing, which is a green light for the Fed to continue to raise rate. Recently in November, after Michael Burry said white-collar layoff is coming, we are seeing a lot more layoff from a lot of companies like Meta, Amazon, and Lyft. Even ExxonMobil, the big oil company that is making banks right now, is cutting back on their campus. Do you believe me if I told you that the Fed will keep on raising rate even in a recession? Does this mean TLT could never get a break and move up? Why does Warren Buffett have so many energy stocks in his portfolio? Will the US dollar survive this bond market illiquid spiral? These questions are all interconnected in a way. I will explain the mechanism behind them right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. You know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want it to be true. You need to be my client, don't you? The US dollar is wreaking havoc globally, and it's only just starting to pick up momentum. You'd have thought by now that other nations would have bailed from its hedge money. But in reality, there's no way out. Right now, the consensus belief is that global liquidity has been deteriorating rapidly, and intervention by the Federal Reserve will come shortly when something breaks. Though, since nobody can decide what that something might be, this shows fear remains in its early innings. With record high consumer loans, commercial loans, wage growth, and net worths, plus trillions of dollars of liquidity still swashing around the financial system, the infamous Fed pivot remains a pipe dream. Plus, as officials become more like vigilantes, the Fed is likely to raise rates higher than anyone expects. Cleveland Fed president recently revealed the Fed would raise rates even in a recession. Worse for pivot advocates. The Fed doesn't seem to care much that additional interest rate hikes will inflict significant pain on the rest of the world. In a move that will likely make the history books, the United Nations even warned the Federal Reserve to stop raising interest rates further. In response, Federal Reserve Chairman Jerome Powell responded with a resounding no, prioritizing the Fed's domestic anti-inflation agenda over the financial health of emerging nations. These are countries starting to again feel the burden of living in the US dollar hedge money. If the Fed continues hiking, dollar strength will almost certainly intensify. Rate differentials will widen and dollar-denominated debt will grow more costly to service, inflicting extra financial pain outside America's borders. Meanwhile, however, on U.S. shores, the outlook is looking much rosier. Something breaking could take longer than most anticipate. The threat of looming breakage lies in the most unsuspecting of places. After the Fed, with varied success, has spent just over a decade trying to create stability in the money markets, imminent peril has now been transferred to none other than the U.S. Treasury market. Recent Treasury market data from Trace does show trading volumes in the Treasury market reaching recent highs, just as 10-year yields have fallen back below 4%. But this won't last. Even with a deep, liquid bond market, a luxury that only the U.S. can enjoy, increased periods of illiquidity will emerge as the Fed's merciless rate hikes continue well into next year. It will be surprising to most, however, that a major goal of rate hikes is not only to set the price of money, but to devalue or destroy the value of government bonds. When the Fed signals rate hikes, higher yields follow and the price of Treasury securities plummet. Investors who hold these securities don't just feel the pain of a loss in principal. The bond's value. If they want to sell, they must face a bond market that's close to entering an illiquidity spiral. When Treasury market makers expect increased volatility via rate hikes, they price in wider bid and ask spreads. In these conditions, price impact rises. Investors bear a higher average loss when they sell and pay a loftier price when buying treasuries. As the Fed reduces Treasury market liquidity, volatility creates more illiquidity, and illiquidity leads to more volatility, resulting in a doom loop that eventually gets too much for most market participants to endure. In practice, the three segments of the secondary Treasury market, interdealer broker, dealer to dealer, and dealer to client, start to break down. Participants unwind trades and hoard collateral en masse. When panic ensues, intervention by central planners is not a question of if, but when. The recent carnage in the UK was only a warm-up. Even without the awful response to UK Prime Minister Truss's fiscal plans, Britain's bond market was destined for the liquidity spiral that unfolded and continues to unfold. Now facing a similar scenario, the US edition will hit our screens shortly. The MOVE Index, which estimates short-term Treasury market volatility via one-month options, has been grinding toward all-time highs. Liquidity has diminished, but slowly without panic. For now, we're nowhere near the extremes. During the LTCM bailout, the MOVE Index skyrocketed to just below a 200 reading. This was a feat only topped by the 2008 financial crisis. As Treasury volatility climbed to a whopping 217 as Lehman Brothers collapsed. Soon enough, though, we'll hit a breaking point when the U.S. can issue an endless supply of government paper, which only a finite number of market participants can absorb. An illiquidity spiral is likely the end game. The Fed will respond and come to the rescue. With all these hazards, it must be difficult to believe how countries have put so much trust in the US dollar and its many derivatives, say treasuries, but finance is a relative game played on a global stage. Countries want to leave, but leaving involves suffering unimaginably economic and financial pain. Abandoning the U.S. means abandoning the only power capable of creating stable capital markets. America is the sole region possessing the continuity and economies of scale that attracts a large investor base. In a world where America plays this seemingly eternal role of global cashier, maintaining liquidity takes priority over financial sensibility. Over time, the monetary paradigm has shifted, so we desire liquidity above all else. We've turned finance into monetary alchemy. Like Warren Buffett said during 2020, never bet against America. The reason why he owns so much Chevron and Occidental Petroleum shares are because when bond prices goes down, oil prices tends to rise. It's a bet for inflation continues to go up. This trend started in 2021. It hasn't changed at all. Maybe inflation will last quite a while. As for the fate of the US dollar as a reserve currency, we will learn a lot when China invades Taiwan and see the outcome of that event. Watch out for all the Chinese stocks. By that I mean semiconductor stocks, Apple, Tesla, and so on. It's like a time bomb. Tick, tick, tick. And then boom. In 2021, Michael Burry actually called inflation is coming and trying to short TLT. Now we know he is right at the end. Just a little bit early. Okay, now I'm going to show you my clients David Vine and Jay Ma's book, Ignite the Passion, Co-Create Your Dreams. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It's an erotic novel, such an amazing book. And my first book, Treasures Within Our Heart. You are such a good boy for watching my video right till the end. Bye.